All three banks have announced their results for Q3. In this video, we will go through their individual earnings and have a summary at the end to compare between their results. To give a very quick introduction to banks for those who are new, banks have two main incomes. First is the interest and the second is the non-interest income. Interest income are the incomes earned from the interest of debts, which essentially are the difference they make using customer deposits. Non-interest income are the rest of the business of the incomes, such as credit card fees, wealth management fees, or trading income. Now with this, let us go right into their results. Let's go on to the first bank, and that will be UOB Bank. For this quarter, net interest margin continues to have a large drop of 0.9% quarter over quarter, resulting in a 0.23% year over year. This is the reason why their net interest income continues to decrease. On the positive side, their non-interest income this quarter came in good with fee and trading incomes increasing. Non-performing loans is still at a decent level of 1.6%, while CET1 ratio has dropped significantly by 0.7%. Moreover, this quarter, their net profit is down significantly due to the preemptive provision set aside for this quarter. This is concerning as a large amount of allowance is set to cover for any potential losses that might be coming from their loans. We will check later on what happened that resulted in them to have such a large allowance for credit. This is one of the reasons why their share price dropped immediately after the results were announced. Looking at the balance sheet, net interest income and net fee income dropped by 3%, but the other interest income was slightly up by 5%. We can see that because of the large allowance set aside, their net income dropped significantly by 67%. For their asset under management, it's doing decent with an 8% year-over-year growth. However, it's important to see if the growth in this AUM is able to offset the drop in the interest income. Later, we will compare with the OCBC and DBS AUM to see the difference. Looking at their net interest income, because of the drop in the net interest margin, it led to a 3% drop in their interest income. The low increase in the non-interest income was unfortunately unable to offset the declining drop in the interest income. This is one of the main reasons why some of the investors have concern as their dividends for the last quarter of the year might come in lower. Their fee income increased largely thanks to the improvement in their credit card and wealth management. Unfortunately, even with their aggressive expansion when they purchase city overseas businesses, I would expect their wealth business to increase much significantly, similar to DBS. However, it's currently not showing in the results. One of the highlights for UOB this quarter's earnings is definitely the large increase in the allowance. The CEO mentioned that it was prudent allowance set aside for uncertainty, but it still doesn't remove the fear from investors on why they suddenly have such a large allowance required. CET1 ratio dropped more this quarter due to the large amount of allowance set aside. Allowance are insured amount set by the management, so in the event if everything is fine, they will be able to implement the allowance back into the earnings to give to shareholders. For UOB's outlook, the management continues to lower their net interest margin while fee growth seems to have dropped as well. This might lead to lower financial year of 2026 results, and we might unfortunately see their dividends drop slightly if they continue to pay based on the 50% dividend payout ratio. At the current share price, their dividend yield is at around 6.5%, including the bonus dividend. But I will not be surprised if their next quarter's base dividend continues to drop due to the potential of lower income. If you appreciate the video so far, please support the channel by hitting the like, subscribe. Thank you, and let's continue with the video. Now let's go on to the next earnings, which is OCBC. Earnings from OCBC was good, which resulted in an all-time high share price. Their net profit was up 9% quarter over quarter. Customer loans and deposits are up year over year, and more importantly, the return on equity also recovered back to 13.4%. We can see that unlike UOB, even though the net interest income is down, their non-interest income was able to offset the drop, which we will see in the next slide. From this quarter result, we can see that their non-interest income grew strongly by 24% quarter over quarter, which enabled OCBC to have a higher net profit. Like I mentioned previously, with the interest rate coming down, it's very important for banks' non-interest income to increase in order to offset the drop. We can see that the main contributors to their non-interest income came from their wealth management and higher profit in Great Eastern. Impressively, OCBC's wealth income increased by 25% Q over Q, while Great Eastern also increased by 50%. They mentioned that this was due to the improvement in the investment performance, so we have to see if this increase is sustainable in the subsequent quarters. Net interest margin continues to drop, which is expected, but thanks to the higher volume in customer deposits and loan, it was able to slightly offset. Non-interest income was fantastic this quarter with a huge increase, and their non-interest income is 41% of their overall. With the trading income being one of the main drivers, there will definitely be risk of fluctuations in their earnings. So I'll be cautious on their next quarter earnings as the Q4 historically was lower. This portion of the non-interest income is important where the wealth managements tend to be more stable. We can see that for this quarter, there's a large increase, which is very good, which means that there's more funds being attracted into OCBC. For this quarter, their CET1 ratio increased back to 16.9% after the dividends were given last quarter. This shows the sustainability of the dividends, and with the increase in the net profit this quarter, there's a chance that we might potentially see higher dividends. It's a decent report, so we will see in the next quarter if the OCBC non-interest income can keep up and able to announce higher dividends. At the current share price, its dividend is around 5.5% and assuming a 60% dividend payout ratio. Next, let's go on to one of the best stocks in Singapore, and that is DBS Bank. Time and time again, they have constantly shown that they are the standout performer out of the three banks. Looking at their highlights, total income is at a record high of 3% year over year higher. This was thanks to the huge growth in their non-interest income contributed from fee, treasury, and market trading. They also mentioned that their net interest income has little changed due to the strong deposit growth, which I've mentioned before. Non-performing loan is decent, with ROE continues to perform well at 17.1%. Their CET1 ratio only dropped by 0.1% from previous quarter due to the high amount of dividends given. For the quarter-over-quarter results, it shows the strength that DBS continues to have with record income and profit before tax. However, we can definitely see the impact from lower interest rate as their net interest income dropped by 6%. Their non-interest income has been more than enough to offset the drop, which led to record profit. This is one of the main reasons why their net profit is up 5% quarter over quarter. Thanks to their strong result, time and time again, DBS has shown against all odds to perform better than the rest, and this led to the continuation of record earnings. Looking at their breakdowns, we can see that the net interest margin has dropped to 1.96%, which was expected considering the low SORA rates. Their net interest income dropped by 1.8%, which is decent. DBS continues to impress in the non-interest income side, with their wealth management increasing significantly by 23% quarter over quarter. Like the management said, as more money comes to the bank while they expand their crypto and overseas business, especially in Taiwan, I see them having more opportunities to continue growing. We can see that their AUM for wealth management has continued to increase significantly by 30 billion. As this strong growth continues, it will definitely benefit DBS in bringing in more income. Moreover, with more good news as collaboration with private banking, this will allow DBS to have more opportunity to expand their AUM as they get more access to customers. We can see that for their CET1 ratio, is expected to continue dropping considering the high dividend payout ratio of around 70%. But with their ratio dropping slowly due to the growing profit, DBS will definitely have no issue continuing to give their bonus income in the next year. We can see that just 3 quarters into financial year 25 is already higher than FY of 24. If all goes well, their dividend announced next quarter might be 81 cents because during their earnings call, they say that they are still going to return capitals to investors. They mentioned that so far of the committed capital return of 8 billion, 371 million was paid through share buybacks, while 850 million through dividends. It's about 15% of the committed amount. They expect to pay capital returns for 25 financial year 25, 26 and 27, with dividends continue to increase by 6 cents, while bonus dividends of 15 cents expected to continue until financial year 27. This is very optimistic as their business shows that they continue to improve while dividends are being laid out to investors. However, these are just forecasts by the management. In the event if there's recession or anything happens to the company, dividends increase or even decrease will be expected. At the current share price, their dividend payout ratio is at 72% with dividend yield of 5.65%. Now, if we look at the comparison table that I've summarized for this quarter's results, DBS continues to prove why they are the better banks out of the three. Like I mentioned, with interest rate decreasing, it's very important for the non-interest income, especially the wealth management fees, to increase. If we compare just the wealth management fee alone on their growth rates, OCBC came in strong thanks to this quarter's unique results with 34% year-over-year increase, DBS at 30%, while UOB is only at 19%. UOB's is the most disappointing considering they have purchased a decent amount of Citigroup's consumer business. Even though DBS percentage is lower, their amount increment is actually larger than OCBC. If we look at their overall table, net interest income of all three banks are dropping, but the good news is that for the outlooks for the banks, they are expecting the margins to stabilize because we can see that for Singapore SORA's rate is already almost reached a plateau low of 1.2%. So for those who are new to SORA rates, it's a reference Singapore use as interest rate. So with Singapore having majority of their loans in Singapore, this rate is very important for their income. DBS continues to be priced at a premium as their ROE, which is the return on equity, is much higher than the other two banks, which shows the business efficiency and profitability in bringing in higher returns on their assets. Moreover, DBS CET1 ratios continues to be strong even with a higher dividend payout ratio of 72% compared to the other two banks. By comparing the dividend yields of the three banks, DBS and OCBC is almost similar at 5.5% range, while UOB is higher at 6.5%. However, the risk is that UOB's dividends might drop while DBS dividends is expected to increase. At the current moment, DBS continues to outperform the other two banks and is the one that I'm most optimistic with. If you have enjoyed the video, please support the channel by hitting the like, subscribe, and comment on your thoughts on the three banks' earnings. Thank you, and I'll see you in the next video.